What's up, credit experts? Today, I want to go ahead and ask you guys a couple of questions. Why are the credit bureaus important? What significance do they have in the credit landscape? And what are some of the benefits and also some of the problems that are associated with the big three? These are a few of the things that we're going to be talking about and more. So thank you guys for watching the Credit Repair Experts, where we do a deep dive into the complex world of consumer credit. In today's video, we're going to be discussing the role of the credit bureaus from the lens of a general perspective. So, without further ado, let's go ahead and begin. The credit bureaus play a crucial role in the financial system by collecting, maintaining, and also providing credit information about individuals and businesses. So, here are about 6 ways that the credit bureaus are important. So, number 1 is creditworthiness assessment. So the credit bureaus collect and maintain very detailed information about individuals and businesses' credit history. This includes their borrowing and their repayment patterns. They take this information and they compile it into credit reports, which then serve as a crucial tool for lenders to be able to assess creditworthiness. Now, by reviewing these credit reports, lenders can evaluate an applicant's past financial behavior, including their payment history and outstanding debts, and also any defaults or delinquencies. They make this assessment, and it really helps lenders to make informed decisions about whether or not to approve a credit application, and also what interest rates do they offer. Number 2 is also risk management. So the credit bureaus provide risk management tools to lenders that help them to evaluate the risk level that's associated with extending credit to a particular individual or their business. The credit reports and the scores generated by the bureaus enable lenders to assess the probability of repayment and also to make sound lending decisions accordingly. For example, if an individual has a history of timely payments and also low credit utilization, then they're generally considered to be less risky borrowers. On the other hand, if the person has a history of missed payments or high levels of debt, then this may indicate a higher risk associated with lending to them. Number 3 is fraud prevention. Credit bureaus play a vital role in detecting and preventing identity theft and fraud. So by maintaining comprehensive credit reports, the credit bureaus can identify suspicious activities or discrepancies that may be an indicator for fraudulent behavior. For example, if a credit bureau notices multiple applications for credit cards or loans and they use the same personal information, it can actually raise a red flag or an alert at the relevant parties. That's generally why they tell you you can only apply to so many lines of credit a month. Additionally, the credit bureaus also offer fraud alerts and credit monitoring services to consumers. This enables them to be able to detect any unauthorized activity in their credit files. Number 4, access to better credit. Credit bureaus actually help us facilitate access to credit for individuals and businesses. So by providing lenders with accurate credit information, the credit bureaus enable them access to an applicant's creditworthiness in a very timely manner. This really helps to streamline the process for the credit application, and it helps borrowers to secure credit in more favorable terms. For individuals with strong credit history, access to credit can actually lead to lower interest rates, higher credit limits, and in general, more favorable terms. For those with limited or poor credit history, the credit bureaus help provide an opportunity to build credit over time by demonstrating responsible borrowing behavior. Number 5, economic stability. Credit bureaus contribute to the overall stability of the economy by providing responsible lending practices. By providing lenders with accurate information, credit bureaus actually help mitigate the risk of excessive lending or subprime lending practices. So whenever lenders have access to more comprehensive credit data, they can evaluate an applicant's creditworthiness more effectively. Thus, they reduce the likelihood of extending credit to individuals or businesses that actually may be struggling to repay their debts. This responsible lending behavior contributes to the stability of the financial system, and it helps to reduce the chances of widespread credit defaults or a financial crisis. So, item number 6 is credit scoring. The credit bureaus generate credit scores. These scores, which are numerical representations of an individual's creditworthiness based off of their credit history. Credit scores actually provide a standardized metric that lenders can use to quickly assess an applicant's credit risk. Then they take this information and they condense complex credit information into a single number. This number makes it easier for lenders to compare applicants and also to help them make consistent lending decisions. Credit scoring models also take into account various factors such as payment history, utilization, your length of credit history, your types of credit, and also new credit applications. A credit score generally is an indicator of low credit risk, and it also helps the likelihood of approval for credit applications at more favorable terms. So, in summary, the credit bureaus are crucial for assessing credit worthiness, managing risk, preventing fraud, facilitating access to credit, promoting economic stability, and providing standardized credit scoring systems. Their role is really an integral part to the smooth functioning of the financial system, and it really benefits both lenders and borrowers. However, while this sounds great, surely the credit bureaus do play a crucial role in the financial system. There are some negative aspects associated with their operations. So, here are a few criticisms or concerns regarding credit bureaus. Number 1 is inaccurate information. The credit bureaus often contain errors or inaccuracies in their credit reports. And these errors can really range from just a simple data entry mistake to way more complex issues like identity theft or incomplete reporting by lenders. Inaccurate information in credit reports can actually have a significant consequence for individuals. It can negatively impact their creditworthiness, and it also it affects their ability to be able to access credit at more favorable terms. Consumers may really need to go through a disputing process to rectify these errors, and that can be time-consuming, expensive, and honestly just quite frustrating. I've been there myself. Number 2 is a lack of transparency. So credit bureaus, their credit scoring models and algorithms used to calculate credit scores are proprietary, and this means that they're actually not made public. This lack of transparency can actually make it really challenging for individuals to fully understand how their creditworthiness is evaluated. And as you may be aware, if you're not able to actually accurately evaluate your credit, then that means a lot of consumers are just completely unaware of any of these specific factors that influence credit scores and also how they can improve those. This lack of transparency can lead to a lot of confusion and frustration, and individuals may not have clear guidance how to address issues or improve their credit worthiness. So, number 3 is limited information coverage. Like we were just talking about, credit bureaus primarily rely on data that is reported by lenders such as banks and credit card companies. And this really means that they may not capture the complete picture of an individual's financial behavior. For example, positive financial activities like paying your rent on time or your utilities, these may not be included in your credit reports. And that would potentially overlook really valuable indicators of creditworthiness, especially if you're paying those things on time, every time. This limited coverage can result in an incomplete representation of an individual's creditworthiness, and that would potentially affect their ability to be able to access credit on favorable terms. Number 4, impact on vulnerable populations. So traditional credit scoring models used by credit bureaus may not adequately consider an alternative data or factors that could reflect the creditworthiness of individuals from vulnerable populations. For instance, individuals who have low incomes or limited credit histories may actually face difficulties accessing credit due to an emphasis on past credit behavior in these specific models. Now, this can actually lead to the perpetuation of financial inequity and also create barriers for those who are already marginalized. It's actually really important to develop more inclusive credit assessments and assessment methods that consider a wider range of data and some factors to provide a fair evaluation of creditworthiness. Number 5, limited control over personal data. Credit bureaus collect and store vast amounts of information of personal and financial information, which raises concerns about data security as well as privacy. The concentration of sensitive information at the hands of just a few credit bureaus creates this potential for a data breach or unauthorized access. Individuals may also have limited control over their own credit and may face challenges in managing and protecting their personal information. This lack of control can then lead to concerns about identity theft, privacy breaches, or the misuse of personal data. Number 6, impacts on credit access and pricing. So, credit scoring models used by the bureaus can influence access to credit and to pricing. Traditional models actually very heavily rely on an individual's past credit behavior, which can actually lead to a disadvantage for people who have limited or no credit history. Younger individuals or say like people like recent immigrants, for example, they may struggle to access credit due to a lack of established credit history. Additionally, the credit scoring models can impact the pricing of credit, as individuals with lower credit scores may also face higher interest rates and also less favorable loan terms, which could be considerable if you're doing anything like considering, trying to build wealth, like getting your family a house to create generational wealth, or whenever you're trying to say create a business and you have to use your personal credit as an underwriter. This can actually also further exacerbate the financial disparities and also limit opportunities for individuals who have lower credit scores. So it's important to note that there are steps towards addressing these concerns that involve a combination of efforts from credit bureaus, regulators, and also industry stakeholders. So improving the accuracy through better data reporting, increasing transparency in scoring models, considering alternative data sources, enhancing data security and privacy measures, and also providing financial inclusion are all important steps towards creating a more equitable and consumer-centric credit reporting system. Additionally, regulations and institutions like the Fair Credit Reporting Act or the FCRA, along with the Consumer Financial Protection Bureau, which is the CFPB, provide better consumer protections and also they dispute resolution mechanisms to address inaccuracies in credit reports. Overall, while the credit bureaus serve important functions in the financial system, it's really crucial to address these concerns and also work towards a more transparent, accurate, and inclusive credit reporting and scoring system. So that pretty much wraps up our deep dive into the credit bureaus. So we discussed 6 ways that the credit bureaus provide information and also 6 downsides to their current reporting standards. I hope that you guys found this video insightful and empowering. And remember, that by understanding how the credit bureaus rate your credit worthiness, you can navigate your disputes with greater ease, have a more comprehensive view on what your reports are supposed to generally look like, and also you can convey any discrepancies that you discover. So before we wrap up today's video, I'd like to ask you guys a question. Do you guys think that current scoring methods used by TransUnion, Equifax, and Experian are fair and accurate? Or do you think that there should be revisions made to make credit more accessible and inclusive to everyone? Let me know what you guys think in the comment section down below. So if you enjoyed this video, remember, give it a thumbs up. It helps us pop up higher in the algorithm. And also subscribe to our channel for more credit tips and insights. Also, hit that notification bell to stay updated. Share this video with your friends and family who might benefit from the information. And together, let's conquer the world of consumer credit and build a brighter financial future. Take care, everyone.